Hello friends, before going to start my talk, I want to say that there is nothing good in the war except its end, because humanity, environment and economy badly suffer during the war. I wish safety and well-being of all the people who are suffering right now in the war, including Indian students. So during this war situation, many investors feel panic and they take decision irrationally and they sell their investment. What we have to do during this situation, and not only this situation, because war is a adverse event happening in a large population, but there are many events which affect adversely individually. So in this video, I discuss approach and strategy which will help you to protect your portfolio, your investment, not only war situation but any adverse situation. And not only protect, it will help you to grow in long term. Now I will go systematically. So be connected with this video till end. Now, as an investor, when you start your journey, first you have to focus on making a defense system to protect your financial goals. The defense system include insurance like life insurance, health insurance. Now the next step. Next step is one should make a emergency fund available. The emergency fund should take care of routine expenses of minimum 6 months to 24 months of this family. Now, after establishing defense system and emergency fund, you have to focus on investment. When you start to focus on your investment, you have to first think about asset allocation. Asset allocation include real estate, gold, fixed income, and equity. I'm not talking much about real estate and gold in this video because most of Indian middle class people have already large chunk of investment in these two asset class. Their majority portfolio positively skewed toward real estate and gold. Now fixed income. So fixed income, I'm not talking about PPF or FD, because according to me your fixed income should take care your near term goal, and FD and PPF are long duration investments. So which type of instrument I am considering? Liquid debt fund, short term debt fund, and in rising interest rate scenario like in current scenario, you should consider floating rate debt fund. And also you should focus that this debt fund investment should be in government bond. Okay, because government bond are as safe as much your FD. Even you can consider more safer. Goal which will due within 3 years. Your corpus should be allocated in this debt fund because your primary goal is capital protection, not a return or growth of investment. Now what you did? You did insurance, emergency fund, and you also take care about your near-term goal which have a 3-year duration. Now you can control your emotions even in war-like situation, because any war except world war, no war will be longer than 2 year, 3 year. So your near-term goal, your current expenses, your insurance, your protection, everything will be taken care. Now you should think about the investment, equity investment. So when you start thinking equity investment, your first question should, why did you invested in particular stock? What your rational thinking, what's your logic behind that? It should consider management, business perspective and valuation. Do you think that any war can affect management? Now second is a business perspective. Business perspective, possible. It may or may not affect business perspective of particular company which you have invested. So if you think that the war-like situation will not affect business of the company where you invested, then you don't have to worry. But if the answer is yes, if it will affect the business, then you have to dig out it will affect permanently or temporarily. It will be structural damage or temporary damage. If it is structural damage or permanent damage, then you have to think to exit from this investment. I think this is a rare situation. In majority case, it impact only temporarily, and you can get advantage of this. How? Because most of retail investor will sell their investment during this period. Not only retail investor, institutional investor and fund houses also sell their investment. The reason behind this, they know the fundamentals, but they feel competition. They have to show their performance monthly, quarterly and annually, and that's why they don't wait for company's performance for next 6 months or 1 year. Rather, they choose the company which will perform in short term, and they are ready to take that risk. But this is advantage for you as an individual investor, because you are not in competition with anyone, and you should focus in long term where the fundamentals are strong. So when the other investor, including retail investor, fund houses and institutional investor, when they sell this type of stocks, there may chance that you will find this type of stocks at a very cheap value. This is the advantage of as an intelligent investor. I'm talking about value investment. So don't confuse with average out, because I don't believe in average out theory. Now, what is the difference between value investment and average out theory? In value investment, we focus on value. When 100 rupees value, if we get it a 50 rupees price, then it is our benefit. That is a value investment. Or even though if we will get it's below 100 rupees, that also is a value investment. Okay, that is a value investment example. What is average out theory? In average out theory, investor don't know the value. They only focus on the price. Best example is a Yes Bank scenario. Stock price was 400. When it dropped to 300, investor feel that it is a cheap price and they try to average out. Then it went below to 200, then 100, and these people average out. They don't know the real value. So this is the difference between the value investment and average out theory. So don't rush or run behind the average out. Focus on the value investment. Above all of this, we'll also go through historical performance of stock market during and after this war, because this war is not first time. So as you can see in the graph, many times, including World War I, World War II, Vietnam War, Korean War, Gulf War, 9/11 World Trade Center attack, during all this, almost 11th out of the 12 time, stock market performed positively after war. As a conclusion, you should not worry, you should not panic, you think rationally, you should build your portfolio holistically, you should play like a Dravid, because this game is for long term. This is not a T20. Thank you, friend. I hope this strategy will help you during any panic situation. It will help you to make calm and give you a peaceful sleep at night. If you like this video, please don't forget to hit like button. Also, please subscribe and share it with your friends, family and colleagues, so they will also get benefit. Thank you.